Many trades are lost like this, with the correct market analysis, trend identification, and entry structures. But there's one concept traders leave behind, and that is what we're going to talk in this video. So let's get it started and find out what is it and how to solve it. Now, when we're looking at this chart, there are three different views that traders can analyze. The first trader is more focused on what the market is doing overall on the swing levels. He questions himself, is the market in an uptrend forming higher highs and higher lows? Or is the market in a downtrend forming lower highs and lower lows? This trader only looks to buy long the swing lows and sell at a higher price near the swing highs. So when this trader sees this price movement, he instantly thinks that it's over, the market is reversing, and now instead of buys, he looks for selling setups. But what is the problem with this approach? Well, what if this entire downwards movement is just a high time frame pullback that we see on the lower time frames? And this break of the lows is just a liquidity sweep, or simply just a random wick? Well, in that case, there might be a high likelihood that he's been trapped, and the market is ready to continue into the highs, this stopping him out of his trade. And then there's the second trader. This trader only looks on the internal levels. So basically, if this is an uptrend, he looks for the moment where the internal trend flips and aligns with the external trend. This happens when the market forms a market structure shift on the internal trend, so on the pullbacks, and if they see that the pull might end, they look for a demand or a support near those levels to take the market into new highs with a buy positions. They usually have a tight stop loss and a large take profit. It's why they trade the internal trend, because if you're very good at it, you can snipe perfect entries. But everyone thinks they can do it themselves. But in reality, most can't do this properly and sustain such a huge risk to reward. The market can and will most of the times form a market structure shift on the internal level, while also having formed a demand or a support, so these traders enter the market with a buy, with their stop loss below the lows, and take profit above structural swing highs. And what they often experience is that the price just continues to fall down, stopping them out, just for later to actually form the valid trend shift. So there's actually so many shifts that it's very hard to know exactly which one we'll respect. But now, there comes the third trader. This trader knows how to read both the external price action and internal as well. But this trader knows one more thing. And this thing can combine both the external with the internal to know which trend has a higher probability of giving out a winning setup. And this thing is reading candlestick properly. This is a very simple concept in theory that most traders don't care about and see it as a beginner's thing. And they miss out a lot because each candle says something. The price, after all, is just the result of a fight of sellers and buyers. So you can psychologically view the market as a battle. If a bullish candle with a large body and small wicks has formed, well then there's a higher chance that the next candle will also close bullish. And this works in a chain effect, forming a very bullish upwards price action. Now keep in mind, this is not about certainty, but it's about increasing the probability of catching a good setup. The opposite is also true. If a bearish candle that has a large body with smaller wicks print on the charts, there might be a higher probability that the next candle will also close bearish, and the chain effect is still applied. So this is such a simple thing that many traders skip or don't apply at all. They make the mistake to only look at highs and lows, but nothing about buying pressure or selling pressure. But there is also another type of candle. This large bullish or bearish candle is called a continuation candle. But the second important candle pattern to understand is the reversal candle. The reversal candle has a small body with large wicks. And what it does is that it reverses the trend. So for example, if the market follows a downtrend and a bullish reversal candle prints, there is a higher probability that the few next candles will close bullish. But if there is already a sequence of bullish candles, and especially a sequence of large bullish candles, and then a bullish reversal candle prints, this indicates that the buying pressure is decreasing. In other words, buyers are losing strength, and there is a higher probability that the market will soon print a few bearish candles. Now there is also the bearish reversal candle. If there is a sequence of bearish continuation candles, and then a bearish reversal candle forms, this indicates that the sellers are losing strength. Sellers no longer can push the price lower, and this creates an opportunity for buyers to take control. But if the market forms a sequence of bullish continuation candles, and then a bearish reversal forms, this indicates that buyers can no longer take the market higher, and sellers might take control on the market. Here on the euro against the dollar, the most popular FX pair, and specifically on the 15-minute chart, we start analyzing the whole price action. At the start, we've had an upwards impulse that sets a local high, from where the market pulls back down forming a low, but then instead of trying to push above the last highs, it ends up lower than the last high, having formed a lower high. Right after forming a high, the market sells off aggressively and breaks down below the last lows. So we end up lower than the previous lows, so if we were in an uptrend before. Now with this break of the lows and increase in bearish pressure, we are more than likely reversed into a downtrend, and we can see that by what's coming next. But the huge hint here is how much more larger are the bearish candles compared to the bullish candles. That is what shows that sellers are in control. Now when the market forms lower highs and lower lows, having entered a downtrending market, traders look to sell at the highest price they can, and these higher levels are usually near supply zones, or resistance zones. If you're a viewer of my channel, you probably already know what they are, so I'm not going to introduce them. What often happens when the market breaks down below the lows is that it validates a supply. And after a break of structure or a market structure shift, the market will usually pull back. And a pullback on a downtrend is a low time frame internal uptrend. And you will see many times that the internal uptrend ends up exactly on the supply. And this gives sell-biased traders an opportunity to sell short the market. This is basically just a way of holding trend continuation. Now this is when traders make a huge mistake. So we see that it formed a local low from where it starts pushing back up into new internal highs, then pulling back down into higher lows from where traders get hyped and start buying the market, which causes some upwards movement, move that also breaks above the highs. So they see this and they believe that's it. We've reversed into an uptrend now. But what they don't understand is that this whole internal bullish move was just a low time frame pullback on the higher time frame trend, just to fill a supply, a resistance or a bearish imbalance from a certain time frame around these levels. Now we can't see the sell entry structure in this chart, but there should be one that caused this rejection, which is probably situated on a lower time frame. But it's not that relevant to find it. It's just that we don't have an external or high time frame confirmation that this trend has changed into an uptrend. We just have loose signals and nothing certain. So unless a demand started forming and also working, we're not looking for any buys yet. We can see, for example, if we would have taken this as a demand, this would have closed as a loss, here as well, and here too. So we have no confirmation that a demand is working. So what do? If buys are not working, we just look for selling opportunities. Pretty logic, right? So what's coming next? Price pulling back down with increased selling pressure once again. This breaking internal support. After each breakdown, the market pulls back. And so it does. But it doesn't manage to break above the highs, so it forms lower highs. But more important is that we need to question why it did reject from this level. And the most common answer is because of a selling entry structure. So supply zones are still working, the pullback essentially filling the supply and rejecting down from it into a simple winning trade. This type of trade setup I've shown many times on my channel on dozens of charts. It's basically the simplest way to win sell short setups, and also be realistic with the risk to reward. In my opinion, from what have I seen, 1 to 3 is a great spot, and if you're starting, 1 to 2 is more than enough. It's also important to still analyze how the market behaves during the setup. Here, for example, after the price filled the supply. Afterwards, it broke down below the internal lows, showing that the low time frame trend is bearish, but also broke down below the external lows, showing that the high time frame is also bearish. Now, as I said before, after a break that forms a local low, we usually have an upside pullback. And once again, the pullback ends on a supply. So again, the same setup planning. Push to the downside, pull back to the upside. Here it has also rejected from a supply, and we then broke bearish structure in both internal for the low time frame, and as well as on the external for the high time frame, and this pushes the market into new swing lows. Now we're in the recent price action, so let's zoom in here and see what happened and what could happen next. So far nothing but just continued moving lower, and looks like it formed a local low from where the last candles we see that it's starting to pull back up, and the price is sitting right now exactly on a supply zone. So once again having the same setup planning to take the market into lower lows, basically a break of structure to the bearish side, and that because the market has no sign of bullishness yet, but it's just pulling back up just to sell back down. And this was the first frontward test that closed with a win. We're going to have probably one or two more setups if the market conditions allows it, and if not, we just move on into another market, or simply just come back in another trading day. So once again, as I've said many times already, after a break of structure we expect a pullback. Pullback that often ends on a supply, breaks down below an internal support, and forms another supply that we can later trade. So let's see what the market does. So far it's going all right, pulling back to the upside. But this time we have a breakout, a bullish move that breaks above the internal high. And with crazy large buying pressure, basically most of the candles were closing bullish. So this is the first sign that the trend is reversing. A breakout is not enough, but what actually increased the chances by a lot is the candle momentum that is more advantageous towards buyers so far. These type of movements happen because sellers get exhausted and are leaving liquidity in form of stop losses. Because the market can't just go down forever, it also has to somewhat recover. Here, for example, this upwards movement liquidated all the sellers that had their stop losses near these levels. They were late sellers. They were simply just seeing a downtrend and decided to hope that it will continue, because it has done so far. And that's a great way of thinking it, because you will trade with the trend instead of trading against it. But if we sell short with the trend, like 4 trades, and we win all of them, at some point the loss will inevitably come. But that's not a huge problem, as long as you keep a positive risk to reward, the sweet spot being around to 1 to 3. And for beginners 1 to 2, and above 1 to 3 more, rarely only under certain conditions that I might make a video on the near future. So for traders that don't understand liquidity and internal structure, they just see this move as a low time frame pullback that should fill a supply near the highs. These traders only care about what the market does on the high time frame trend. They don't bother to analyze and see if the pullback has large buying pressure, nor even the market structure itself on the lower time frame. And what they usually do is simply sell short the supply, with the stop loss above the highs of the high time frame supply, with take profit below structural swing lows, having this huge risk to reward ratio that in my opinion it's unrealistic to hold in the long term. Meanwhile, the smart traders are aware of both the external market structure but of the internal one as well. And they see this large buying pressure and they ask themselves that if internal trend has reversed and after the break there isn't any significant pullback to the downside, but the market keeps pushing higher, well then there is a pretty high chance that the market will also reverse into a high time frame uptrend. So that makes selling the high time frame very dangerous. The smart trader instead looks to trade the internal trend until the external one is more clear. And on the internal trend, we see that the price has rejected back down from the high time frame supply, has broken down below internal lows, so it validates a supply zone on the internal price action from where the market rejects back down from the newly formed lower high. So the traders that were looking for the internal trend saw this as an opportunity to sell short into new lows. And that's a fair trade. I would also choose this setup but without targeting the structural lows, and instead targeting a 1 to 3 risk reward. So coming back into the price action, after filling the internal supply, we get another rejection to the downside, rejection that breaks down below the internal lows, forming lower lows, and here once again shortly after, but now we see that bullish pressure is once again coming back in, with the market printing a huge bullish candle, larger than any recently bearish candle, and this candle breaks above the internal lower high. So having formed an internal market structure shift towards the bullish side, this basically looks to be the end of the larger time frame pullback. For example, this is the push. Then we got a pullback. And now that the pullback looks to be ending, the market could likely continue the uptrend. And if we look closely, on the last candle, the price is sitting right now on a demand level. The demand also has a fair value gap above, making it even a higher quality demand. You will often see that demands that have an imbalance above will respect more than if they wouldn't have the imbalance. And for the supply as well, if it has an imbalance below, well then that supply has a higher chance of respecting. So knowing this theory, we would look to trade along this internal trend. So if the market would respect our bullish bias, it has to bounce from this level, so might as well take advantage of this possible move with a buying setup on the demand. Stop loss below the lows of the demand. Take profit at 1 to 3, which also coincides being above the first structural high. also above this one, and actually above many of them, including the major structural high. So after filling the gap, it moved into the demand and rejected right back to the upside with very bullish candles, eventually breaking up above the last other structural high. The buying pressure has kept going. That is why it's also very important to not only look at market structure, but also at the size and volume of candles. And now it's getting very close to the take profit area, while losing the first two setups. Setups that most likely were done by traders that only looked at the external market structure and didn't consider the internal one, but also didn't consider looking at candle behavior. But still, 2 losses coupled with a 1 to 3 risk-reward win still ends up in profits. So, as a quick summary of the lesson you need to learn from this video, the key point besides understanding the market structure, the price action analysis, and identifying the entry zones. The main point is understanding the pressure of buyers and the pressure of sellers. Usually on a downtrend, traders will look for sells on the highs, but they don't look at the candle pressure. So if this pullback is formed with slow upside candles, with larger bearish candles, but still slowly climbing to the upside, well then, this is a valid pullback that should respect the high time frame supply. But if this pullback is formed with increasingly bullish candles that are larger and more frequently formed than bearish candles, well then the trend has likely reversed and this supply will probably break and invalidate. But before the break of the supply, we should already be knowledgeable enough to find trading opportunities on the internal trend. And instead of selling short the high time frame external supply, we look for buys in the internal structure. We are essentially trading with the low time frame trend, which is bullish. And this was it for today's video. If you want more specialized information, make sure to check our website in the link in the description, and also feel free to watch our recent videos and view my posts on this channel. Thank you for watching and have a great trading day.